At 9:42 a.m. on a quiet Tuesday morning, a mortgage trade closed on Wall Street. It was clean, it was legal, it was profitable, and it was impossible. Because the loan inside that trade did not exist yet. Not on paper, not in underwriting, not in the bank's own system, but the investors had already paid for it. The securities had already been delivered. And somewhere inside a regional U.S. bank, a compliance analyst was about to discover that the mortgage industry had quietly reversed the most basic rule of lending. In this system, the borrower no longer came first. The trade did. Being in mortgage compliance was never something Ryan Carter desired. He wanted a profession that was quiet, not a single headline. No politics, don't play power games. Simply follow the process, only the rules, only clean files. He was employed at New York's Summit National Bank, a medium-sized organization, not well known, but big enough to sell Wall Street house loans worth billions of dollars each quarter. On paper, Ryan's task seemed straightforward. He looked over secondary market trade delivery and settlement data, not the consent of the borrower, not judgments on credit, not sales, just one thing. At the time of sale, did the sold loans truly adhere to the bank's own policies? Fraud is what most compliance officers search for. Ryan searched for the right moment, because lawsuits are born at the wrong time. Ryan was given a standard delivery review that Tuesday. Mortgage pool for October. 1,204 loans. Sold to Capital of Summit Ridge. Type of delivery. Pool forward. Nothing out of the ordinary. Before he opened a single file. 78144 is the loan number. Angela Ramirez is the borrower. Timestamp of approval. Trade execution at 6:14 p.m. on October 19. Ryan blinked at 3:02 p.m. on October 18. He refueled. He looked at the latency of the system. He observed the server in the warehouse. Timestamps were accurate. The transaction was closed. The loan was granted 27 hours prior. Ryan assumed it was a data feed glitch. That is what most anomalies are. He cross-checked the trade blotter. Confirmed. He opened the delivery confirmation from the custodian. Confirmed. He pulled the underwriting completion log. Confirmed. He leaned back slowly in his chair. A single loan could be a mistake, but timing errors in securitized pools are extremely dangerous. So Ryan did what compliance is trained to do. He expanded the sample. 10 loans, 20, 50. By noon, his spreadsheet was full. 73 loans. All delivered, all settled, all paid, all approved after the trade date. Not minutes, not seconds, hours, sometimes days. Ryan felt the tone of the room around him change, even though no one else knew what he was looking at. He walked across the floor to the desk of Emily Ross, Wire Operations Manager. "Hey, quick question." Emily smiled. "What's up?" Ryan turned his screen slightly. "These loans, how are they showing delivered before final approval?" Emily didn't lean forward. She didn't squint. She already knew what he was talking about. They're pre-clearance deliveries. Ryan frowned. That's not a delivery category. Emily hesitated, then said quietly, It is now. Ryan was pushed into a silent room that afternoon. Only Mark, Emily, and him. "We redesigned the pipeline," Mark stated. "Who approved it?" questioned Ryan. "Markets for capital." Immediately, Ryan sensed politics. "We developed a confidence model," Mark added. Ryan leaned closer. "That isn't endorsement. We are aware. So why is the money being released?" "Because the model predicts approve better than people," Mark said calmly in response. "Prediction isn't legal," Ryan remarked. Then Mark replied, "We no longer provide loans for sale. We provide certainty for sale." Ryan was called in to an executive's room early the following morning. Risk is inside. Lawful. Jason is in charge of mortgage trading. Jason smiled. Underwriters are not waited for by the market. Ryan stated, "The law does." Jason quietly responded, "The law presumes that delivery occurs upon approval. It is not necessary." Legal gave a nod. Jason went on, "We substitute if a loan fails later." Ryan gave a headshake. "Settled securities cannot be substituted." Jason stated, "We constructed a buffer." Ryan froze. "How large?" $3 billion. Ryan muttered, "Regulators also fail to notice it." Silently, Susan responded, "It's only temporary." Nobody objected. 2 weeks later, Ryan got a call, not from the bank, but from a housing counselor in Phoenix. A borrower named Angela Ramirez was already in default. Ryan opened her file. It was the same loan. The system had rejected it twice. Then it was manually approved because a trade needed it. That's when Ryan understood. This loan wasn't made for Angela. Angela was used to fill a deal. He wrote one line, "The trade creates the mortgage, not the other way around." Ryan submitted a clinical, spotless report. No charges, just one query. Is it possible to sell a mortgage before it has legal status? He turned it in 3 days later. Status: acquired. It vanished 2 days later. Not rejected down. Unmodified. Deleted. An override by an executive. They failed to resolve the issue. They deleted it. In that instant, Ryan realized the bank had decided up its mind about the matter. 3 weeks later, the bank got a routine regulatory visit. Federal housing compliance, standard cycle, no triggers, no investigation. Ryan knew only because his manager forwarded a notice. Regulatory presence on floor. Be available if requested. He wasn't worried until he saw the name. Rachel Turner, Federal Housing Finance Oversight. Precise, not aggressive. She didn't look for fraud. She hunted assumptions. That afternoon, Ryan got a message. Rachel Turner would like to speak with you. In the review room, she sat alone. No counsel. No executives. Just a laptop. A notepad. Quiet intensity. "Thank you for meeting me, Ryan," she said. "I'm reviewing your bank's delivery pipeline." Ryan's chest tightened. "No formal policy describes your pre-clearance model. It's a capital markets process," he said. "And yet it determines borrower outcomes." She asked, "When does a loan exist?" "When it receives final underwriting approval. That is what frameworks assume, yet settlement data shows execution before that point." Ryan's heart pounded.
There's a predictive clearance model to stage deliveries, he said. Stage, deliver, he corrected. How are failed approvals handled? Internal warehouse inventory substitution. Is that inventory disclosed as exposure? No, classified as temporary operational liquidity. Rachel closed her laptop. A structural classification choice, not a violation, a choice. Next morning, calendar full. Risk, legal, treasury, regulatory alignment. Ryan realized she hadn't accused the bank, she'd just asked the wrong question.
The call came from a blocked number. Ryan Carter, this is Deputy Director Alan Brooks, Federal Housing Oversight. Ryan froze. We received your bank's clarification package. Without you. No enforcement action, yet. But were you aware of the pre-clearance delivery model? No. Involved in design? No. Submitted concerns? Yes. Formally retained? No. That is unfortunate. We're assessing systemic risk. Any action would affect multiple institutions. Be careful, Alan warned. Timing can look like misconduct or innovation. The distinction matters. The call ended. Ryan stood, phone in hand. The system might survive, and if it did, someone else would take the hit. Compliance was not the cause of the initial crack. Pricing was the cause. The trading desk silently expanded prices on Wednesday morning before starting to reject locks. Not a memo, no warning. Ryan understood why. The loans used to replace unsuccessful approvals, known as the substitution buffer, were failing. It was displayed on a dashboard. There are 214 loans remaining, 900 plus 3 weeks prior. At this pace, the next failed loan wouldn't be replaceable. And an unreplaceable loan meant a security containing loans that didn't qualify, which meant false investor representations. By Wednesday's pool, 4 loans were unapproved at settlement. That number should be 0. By Friday afternoon, available substitution capacity, 17 loans. Then Emily messaged him. They stopped allowing substitutions after 4 p.m. The safety net was gone. Monday morning, a forward pool failed its internal gate. 7 loans were declined. 7 were already in the delivery file. At 9:31 a.m., a senior manager manually stopped the transmission. For the first time in 5 years, the pipeline was halted. No announcement, no disclosure. Outside the bank, nothing happened. Inside, the machine had reached a point where it could no longer fix itself. The model hadn't failed. Reality had. Ryan did not celebrate. There was dread, not relief, since the bank was now dealing with a separate issue, a story issue. 2 days later, he was called upstairs. Same room, different tone. We'll characterize this as an operational interruption, Jason said. No, Ryan replied. It's a sequencing irregularity, Susan offered. It's a design failure, Ryan said. No one disagreed. That silence told him everything. We need you to help write the remediation plan, Susan said. You erased my first report. That report wasn't right for this stage, Ryan understood. This wasn't about truth. It was about survival. We'll redesign the model, Jason said. Add manual controls, enhance disclosures. And the loans delivered early? Ryan asked. They were approved shortly after. That doesn't fix timing. No, David said, but it reframes it. Then Susan said quietly, the model didn't increase losses, it reduced execution risk. It protected capital during volatility, Jason added.
Ryan finally saw it. The system wasn't built for borrowers or investors. It was built to stabilize revenue, and it worked. There will be no enforcement action, Susan said. Only guidance, David added.
Ryan asked one last question. What about Angela Ramirez? Silence. She defaulted within 60 days. 3 months later, a quiet industry bulletin appeared. No bank named, no model mentioned. Just one line about aligning delivery representations with approval timing. That was the reform.
Ryan resigned 2 weeks later. No whistleblower, no lawsuit, no press. Because the loan sold before approval wasn't a mistake. It was a prototype. And the system had learned how to move legality out of the way.